Hello everyone. In this lecture we will be talking about mutual funds and hedge funds, which hedge funds is a type of mutual funds. What I'm going to do today is basically briefly explain to you what a mutual fund is, what it does, and how it has grown over the years, what its purpose as a financial institution is in the general scheme of the economy and the investment world and everything else, and try to basically tie everything together from not only the institution perspective as a financial institution, but from the perspective of investors, why it actually caters to the investment world the way it does and why it's so popular. So without further ado, let's go ahead and start with our definition. What is a mutual fund? Well, I guess, yeah, I mean, you can read it from the PowerPoints as well, but what I'll try to do is give you a layman's version of what a mutual fund is. It's a company at the end of the day. It's a financial institution, just like a bank. But the unique thing about these mutual funds is that their entire assets are made up of securities, a variety of securities like stocks, bonds, and things like that, where if you become a shareholder in this mutual fund, you essentially become a proportional shareholder of everything that this mutual fund holds. So you can think of it as mutual fund is an investment for you that essentially invests in other things or a variety of things. I'm going to get into details of what types of mutual funds we're dealing with or what kind of investments they make and everything else. But it's important to understand that it's essentially like you can think of it like a flow-through type of a company where whenever you own a share of this mutual fund, you essentially own a proportional piece of everything that this mutual fund invests in or it owns as its assets. So it's very popular. It's extremely popular. About, I'd say, almost 2/3 of all retirement assets are held in mutual funds. So if you don't know what mutual funds already, you better know what they are. And if you're already investing in a 401k or something like that, you already hopefully have heard of what mutual funds are. But let's make sure that we define what they are, what they do, and things like that. Uh, I'll just go for with the bullet points here. 28% of the U.S. stock market and almost 44% of all U.S. households hold stock via mutual funds. That's very significant. What that basically means that 1 out of 2 every household actually has some form of an investment through a mutual fund. That's good from a lot of perspectives, but that actually also gives huge amounts of power to mutual funds in the investment world. That's why, from an academics perspective, whenever we do research related to stocks and bonds and things like that, we also have to pay very close attention to these mutual funds that actually can drive everything that happens, or mostly what happens, in the investment world altogether. So it's not necessarily what stocks do, that is, well, I mean, whenever we do research related to investors and we say, well, investors pick this particular stock because of such and such and such. Well, we also know that half of all households out there actually make their investments through mutual funds. So it essentially becomes the decision of the mutual funds that pick these stocks and bonds and things like that and impact their trajectory in the market. So they're very powerful. And assets that mutual funds hold, as I mentioned in the third bullet point here, have grown substantially over the years. In fact, it's about $15 trillion worth of assets that are held by mutual funds. So very, very significant impact in the market. Okay, so why are they so popular? Well, they offer several benefits to the investor. I'll just go ahead and read it from the PowerPoint and then put it into layman's terms for you. So the first one here says liquidity intermediation. Investors can quickly convert investments into cash. What that basically means is that you can buy and sell any investment you want, obviously. And some investments are more liquid than others. I mean, as I always say, you go into a real estate investment, it's going to be way less liquid than you go buying some other form of investment. The key thing here is that whenever you buy from a mutual fund, especially a mutual fund that's heavily traded, you can turn your investment into cash very quickly. In other words, the ease of getting into these mutual funds is as equivalent as it is to get out of these mutual funds and turn your investment into cash. A lot of times these mutual funds don't trade like a typical stock. They don't trade, let's say, I mean, whenever you go into the stock market and you want to buy a stock, you can buy it right this minute and you can sell it 5 minutes later. A lot of times mutual funds don't allow you to do that, typically to make sure that their investments are not as volatile as what the stock market is doing. Typically they will allow you to buy the fund today and be able to sell it tomorrow. But again, from a liquidity perspective, even if that's the case, it's still pretty liquid to get in and out of mutual funds. The second one here is denomination intermediation. Investors can participate in equity and debt offerings that individually require more capital than they possess. What that basically means is mutual funds have a lot of money and a lot of power because they essentially pool all these investor resources, right? So they can buy assets not only in size but in value that you and I might not be able to afford on our own, or face substantial costs that mutual funds can avert. The third one is diversification. As I mentioned previously, investors immediately realize the benefits of diversification, even for small investments. So in other words, if a mutual fund invests in, let's say, 1,000 different assets, by buying just, let's say, $100 worth of mutual funds shares from that mutual fund, that $100 gets diversified into those 1,000 securities, or thousands different types of investments that this mutual fund essentially invests in. So diversification is a huge benefit. The fourth one is cost advantages. This also ties to something that we mentioned in the previous slide. The mutual fund can negotiate lower transaction fees than would be available to the individual investor. Okay, what that basically means is, let's say that you want to buy 100 different stocks. Whenever you're buying and selling these 100 different stocks, a lot of times you're going to be facing transaction costs per the transaction you do. If you're going to buy 100 different types of companies' shares, each transaction you make will be facing transaction costs. However, mutual funds, whenever you buy and sell a share of a mutual fund and you effectively buy a piece of everything that this mutual fund makes, the costs you're going to be facing will be substantially lower than you would if you were buying those shares individually on your own. Fifth one, which essentially is a debated issue, but a lot of investors see value in this fifth one, is managerial expertise. Many investors prefer to rely on professional money managers to select their investments. Okay, this doesn't necessarily mean that the manager is smarter than you, or the manager is substantially a better investor than you. The argument behind here is that, especially in specialized mutual funds, which I will mention in a little bit, what I mean by specialized mutual funds, whenever you have a specialized mutual fund and you have a manager that only concentrates on that, let's say, particular industry, they get to have a know-how that you and I might not be as good at. So for example, whenever we're trying to diversify among a lot of different investments, right, it's required that we have substantial knowledge about each and every one of those investment categories, industries, things like that. Whenever you put your money into a particular mutual fund and there's a manager that specializes in that particular category, let's say energy funds. Well, this guy knows, or at least expected to know, everything there is to know about the energy sector, what's happening there, what the regulations are, what the oil prices are, what the natural gas is, what are the other countries doing, so on and so forth, a million different things that they get to have that know-how specialized for that category. So we expect to have them, or at least as an investor, we expect that manager to know more about that particular category than we ever could, or we could but we wouldn't know as much in other categories. So from our perspective, it's better for us to rely on managers at different industries, let's say. An industry is just one, I guess, category, but I'm just giving that as an example. And if I rely on, let's say, if I diversify my money into 5 different industries and I pick a mutual fund from each industry and I have a manager that I rely on specializing in each of those industries, I at least expect those to be more efficient in terms of information utilization and reaction time to the market than I would have if I was trying to do all of that on my own. But again, this is a debated issue in the academic world. All right, so in this slide, I'm trying to show you that mutual funds have grown substantially. Now, having said that, they have grown to a large extent and then pretty much stabilized there. But at least it shows you that households, about half of households, inadvertently became investors in mutual funds over time. Again, which gives a lot of power to mutual funds. Here's another way of looking at how powerful these mutual funds became. If you invest in a 401k plan, which is essentially tax-deferred investment or retirement plan that a lot of companies allow their employees to participate in. If you don't know what a 401k is, I guess this is a good time to just quickly Google it. But essentially, 401ks heavily invest in mutual funds, as you can see in this PowerPoint. And I mean, this shows you all the way up to 2020. So you know that it's, again, similar to all that household projection. It's not just the household's investment that has grown substantially, but essentially all of the established retirement type funds, which 401k is one of the most popular ones out there. There are different ones, but 401ks are some of the most popular. I mean, look how extensively those 401ks are invested in mutual funds. So it's not just individual investors, it's the retirement of general population as well. All right, so investment companies offer a variety of mutual funds. So it's whenever you go into an investment company, let's say, maybe you've heard these names before, maybe you have not. I mean, it's okay. Let's say Vanguard or let's say Fidelity. These are investment companies that a lot of people utilize to make their individual investments as well as retirement 401k type stuff. But a lot of times these investment companies offer a variety of mutual funds. So they don't just give you one type of diversified. Again, I'm going to give you more examples of what I mean by different types of mutual funds. But just know that, you know, one shop does not offer you one mutual fund. A lot of times they offer you a large variety of mutual funds, especially very established ones like the Vanguards and the Fidelities or the TD Ameritrades of this world. And the cool thing is, whenever you go into one of these investment houses, you pretty much can transfer your balance, take your money out of one fund and put it into another whenever you see it's necessary. A lot of times, from an investment world perspective, what we a lot of times advise our students as well as the professional investors that don't just diversify among stocks and bonds and things like that, but diversify among mutual funds. And diversification also means that you need to rebalance those monies over time, because some type of funds might become more valuable, some type of funds might lose money at certain times, and you don't want to lose that target balance across time. So and if you put a lot of your money into a specific type of investment company, you can switch your money among a lot of those funds easily. Having said that, I've gotten a lot of students ask me this question before. Is it enough? Because, well, let me start it this way. We always say diversification is key, right? You want to make sure that you don't put all your eggs in one basket. And a lot of times I get students questions saying, well, if I put all of my money in, let's say, Vanguard, and but I diversify in a lot of different kinds of funds in Vanguard, is that enough? Well, in theory, it's not. Well, a lot of people do that, and which is perfectly fine. I mean, these companies are very powerful, very stable companies. But in theory, what we advise you to do is not only diversify your money within a given company among funds, we usually say put some of your money into another company and diversify among the mutual funds that that particular company offers as well, just in case if one company goes down, you're not necessarily facing total catastrophe. All right, so and again, if you invest in one type of company, even if you invest in several funds under that investment company, you will get statements that put a lot of those investments together. Especially during tax times, you get consolidated statements. So let's talk about the structure of the mutual funds. I'll read from the bullet point here and then try to put it in layman's terms. So the first bullet point says closed-end fund. A fixed number of non-redeemable shares are sold through an initial offering and are then traded in the OTC market. Prices for the shares is determined by supply and demand forces. Well, I guess the key thing here is that these types of funds, you become an owner in these funds whenever they're created. So in other words, whenever there's an initial public offering, whenever we talk about how stocks are issued and go through the initial public offering phase and the primary market and the secondary market, things like that, if you remember those discussions, this particular one, everything happens pretty much in the primary market. So you become a shareholder and the shares are not redeemable. You get in at the very beginning. And these are closed-end funds because essentially they get traded or retraded on the OTC or the over-the-counter market, and only supply and demand determine their prices. I think this will be more clear whenever we clarify what the second bullet point is. The second one is an open-ended fund, and I'll read it from here. Investors might buy or redeem shares at any point where the price is determined by the net asset value of the fund. So hopefully you see the difference between the two types of funds. The open-ended fund is essentially free for all. You can come in, and this is a secondary market trade here. That's one of the key things that are different. So you go in and get out of this fund pretty much anytime you want, and it's like a stock essentially, where the net asset value, which I will clarify in just a second, net asset value determines the share of the or the price of the share whenever you're trading this, as compared to the supply and demand forces in the OTC market in the closed-end fund. All right, so let's clarify what a net asset value is. All right, so whenever we talk about a stock, a share price of a stock, ExxonMobil is trading for such and such price, right? There are a lot of things that determine what the price of that stock should be, right? There are fundamental things that determine the book value that determine it, and then there are market forces and things like that. Those are all discussed generally in a different lecture under an investments concept. Now, having said that, net asset value, you can think of it as the share price, essentially, of a mutual fund. Now, whenever we look at the book value of a stock, we say, well, you look at all the equity, you look at the balance sheet and you say, well, assets equals debt plus equity, and the equity part you take out and you divide that equity in the number of shares outstanding in the market. That's how you come up with the book value of per share price of a stock. That's how we do it in stocks. Net asset value for a mutual fund essentially is a very similar process. So how the book value becomes the market value is because everything that the mutual fund holds is tied to the market. So that's why the book value of a share of a mutual fund essentially becomes the market value. So with the stock, they're different. With the book value of a stock, price might be $20, but in the market it might be completely different because the market values that share differently. Well, when it comes to mutual funds, the book value of the share essentially becomes the market price of the share, because everything, or pretty much most everything that the mutual fund holds on to, is traded in the market. So the market price directly gets reflected on the book value of the share of the mutual fund. And how do we determine the price of a mutual fund share, again, similar to what happens in a stock's book value. If you look at the PowerPoint here, it says stocks, bonds, cash, all of the value of the current market value of those guys are added together. Whatever liabilities that this fund, again, essentially this is a company, right? Whatever liabilities this has gets taken out and then gets divided into number of shares outstanding, or how many shares are available and have been traded by investors out in the market, and you essentially come up with per share value, or the net asset value of this mutual fund. All right, so from the structure perspective, how this company or this financial institution essentially is structured is that shareholders are essentially the investors, as I mentioned at the very beginning of this lecture, right? Now, the interesting thing here is that there's, just like another company, there are board of directors, and these board of directors oversees the fund's activities and hires an investment advisor. So you can think of it as hires a manager to manage all this stuff, as well as an underwriter. Remember, whenever we talk about underwriters are the guys that assess the risk and the purchase and the sales of a lot of these assets, right? So that would be the underwriter in this case. And in theory, as I mentioned in this in this slide, in theory, this board can hire and fire the fund managing company, let's say the Fidelity or the the Vanguard or the TD Ameritrade or whoever that is. But a lot of times these companies come with a certain level of reputation that these mutual fund board of directors understand and want to keep. But they have that power essentially. All right, so let's talk about the predominant, and this is not an exclusive list, but it's the most predominant classes of mutual funds. So there are stock funds or equity funds, bond funds, hybrid funds, and money market funds. I will go into a little more detail in just a second. So whenever we talk about how these guys are not formed, but how are they distributed in the mutual fund industry, you can see that a significant portion of them, at least half of them, are in equity funds. So stock-related mutual funds are the king in the mutual fund category. Bonds are still significant. Money market funds are still significant. This hybrid, though, interestingly, is much smaller than people a lot of times think they are. So in other words, whenever I train students in an investment environment and I say, you can look at these types of funds, these types and then there are hybrid funds that actually put a lot of this stuff together. And a lot of times, people who invest in or want to invest for retirement think that these hybrid funds are the best way to go, and for you it might be the best way to go, but people assume that those are the most popular and the most available out there. Not necessarily so. As you can see here, the hybrid funds that put a lot of these bonds and stocks and things like that together are actually a minority in the space of mutual funds. All right, so here I will talk about a little more detail about the types of mutual funds that at least you can commonly see, and I'll go with bullet point by bullet point and then clarify them for you. Other than investing common equity, the stated objective of any particular fund can vary dramatically. We're talking about stock funds now or equity funds now. So yes, they talk, we say equity funds, so they invest predominantly in stocks, but that's where that blanket statement stops. After that, each fund can be extremely unique in terms of which slice or which category of stocks they go into, or which category of equity they go into, and I'm going to clarify those in just a little bit. So let's start with the capital appreciation funds. It's a category of equity funds or stock funds that essentially are interested in one thing and one thing only. At what price do I buy these shares of stocks and what price I sell them? Okay, so here's two ways of looking at it, which actually combines the next bullet point as well. You have stocks that or let me say it this way. Whenever you invest in a stock, you can get money two ways. You can get capital appreciation, which is, let's say you buy the stock at $100 and the price of that $100 or the price of that stock goes up to $200. That's capital appreciation. Well, also, this same stock can be paying dividends on the side. So that's an income side of the stock. So you can say, well, the total money or total return I make from the stock would be the capital appreciation plus any dividends it might pay. The reason I say it might is because not all stocks pay dividends. Capital appreciation type funds only worry about the price increase of that stock, nothing else. The third bullet point here says total return funds. That those guys look at not only the capital appreciation, but they also look at the dividend piece as well. World equity funds invest in foreign firms. So a lot of times when I tell my students how to construct a portfolio, a lot of times I say make sure you have a type of fund in there that invests internationally, especially if we're talking about equity funds. It's a good idea to have some fund as a piece of your total investment that's investing internationally because, you know, yes, some nations perform a lot better than others, but some nations actually can make significant returns over time, compared to more stable nations. So you want to make sure that you don't lose out on that stuff. And sometimes whenever one particular country, let's say your home country, is going through a financial crisis, that doesn't necessarily mean that all countries will go through the same financial crisis. Or, a lot of times they do get impacted with each other, but they won't go through the crisis the same way. Or the companies that are allocated across the globe do not necessarily face the exact same challenges that some other company in another nation might be facing. So it's always a good idea, and world equity funds allow you to do that. The last bullet point here that I want to mention is actually very, very, very important. Now, you might have heard of some of this stuff before, you might not have. That's all right, but I'm just going to clarify them for you. Now, whenever you look at, let's say, United States equities, United States stocks, the companies that are being traded, let's say, in the New York Stock Exchange, there are many ways you can slice and dice these companies. And a lot of mutual funds specialize in those slicing, dicing of those companies. Now, one, category or one spectrum would be size of these companies. You can go from small companies to extremely large companies, the behemoths of the stocks, right? You can go as well as, as small as penny stocks to as large as, apples of this world that are just, the size of countries, right? So the way that we look at them is capitalization or cap. So you can have small caps, or you can go penny stocks, small caps, and all the way up to large caps. Now, large caps don't necessarily mean all of them are the same size. Basically, the market gets divided into specific categories. You can have extremely large companies in the large cap, as well as still relatively large companies, but not as large as the largest. So it usually gets divided into these categories. You have pennies, you have small caps, you have medium caps, and then you have large caps. So you can have mutual funds that invest in those particular categories, or you can have mutual funds that invest in blended size companies. You can have mutual funds that invest in growth funds or value funds. Another name for growth companies is glamour companies. The way that we typically look at this stuff is related to their book equity versus market equity. What that basically means is a company will have a value according to its books. So let's say that the share price of a company should be $20 per share according to its books. Well, the market might look at the same exact company's share and think that it is more or less valuable. For example, according to its books or book equity for a company might be $20 per share. But the market might look at that and say, well, it's worth $40. Now, of course, this discussion is for another lecture entirely, but talking about why the market value of a share might be different than the book value of a share, well, there might be a lot of reasons for that. The company might think, well, although according to its books, it's only $20, but the potential for this company is large, and all these possible investments it can get into are just so significant and so valuable that we think that each share must be worth a lot more than $20. It can be completely the reverse, right? According to its books, this company might be worth $20 a share, but the market might say, well, it's nowhere close to $20. It's only worth $5 to me, because let's say according to its books, this company, I don't know, bought these, buildings that are worth millions and millions of dollars, but those buildings were, let's say, they paid too much for those buildings. So according to its books, they're worth $20 million or $50 million or $100 million, but according to the market, they're not worth as much. Therefore, each share price is not worth as much. You can think of many other reasons why the book value of a company or book share value of a company versus the market share of a company might be different. Now, this brings me to the value versus glamour type companies. Value shares or value companies or value funds who invest in these companies essentially have a low book to market value. So in other words, I apologize. They have high book to market. So in other words, let's say the book value of a company is $20, and the market value of that company per share is only $5. So this would be a very high book to market value company. We call that a value company. Now on the other side, you might have growth companies or glamour companies. Both start with a G. You can have a growth company that actually has a very low book to market equity or book to market value. That basically means that the book price of the share is, let's say, only $5, but the market says it's worth $100. So this would be a very low book to market company, and low BEME or book to market companies tend to be called growth companies or glamour companies. Now, obviously, stocks or the mutual funds that invest in stocks can find one of those channels and invest strictly, let's say, in value companies or invest strictly in growth companies. Now, what you will realize is, let's say, you start your investment endeavors and you go to, let's say, Vanguard or some company like that, and you look at these huge number of available mutual funds for you to invest in, you will realize that a lot of these will be like, small cap value fund. That basically means that this particular fund invests in small size companies that are value companies that have high BEME ratios. You can have, let's say, large cap growth companies. Those companies will be investing in very large company, or those mutual funds will be investing in very large company stocks that also have very low book to market equity. Now, I also get this question a lot from an investment perspective. So why would I want to pick one or the other? Well, historically, companies that are larger and that have high valuations in the market or low book to market equity valuations tend to be more stable, but they don't tend to give you a lot of high returns. So if you pick those types of mutual funds, those will have more steady, so less risky, but lower return type things over time. If you go into the other extreme, you go into value funds that invest in small cap companies, those guys will have higher returns, but because predominantly they end up being higher risk type of funds. So I hope that makes sense. All right, so last but not least, you can go into things that are slicing and dicing these stocks into industries, as I mentioned before. And industry mutual funds are very popular on their own. So you can actually pick to go into industry mutual funds that might blend across related industries, or might go very specialized into one type of industry. Car manufacturing industry, that's a very specific type of mutual fund that only invests in those stocks, right? You can have oil, let's say, mutual fund that only specifically invests in companies that specialize in oil. Or you can have a blended energy. Although it's still specialized in the energy industry, it might have a more blended approach into energy companies. You can have energy companies that are not only at the producing level, but at the guys that own, the companies that might mine this or take this oil out of the ground. That's a specific type of company. Other ones might be actually or actually producing the gasoline, let's say, that this oil that comes out of the ground. You can have other types of companies that specialize in natural gas and or renewable energies and things like that. So this energy fund might be specializing in a wide variety of companies that invest in energy. So hopefully that gives you an idea of how vast this specialization can be in the stock fund world of mutual funds. So, and then there are bond funds. So I'm assuming that you know what a bond is at this point. So bond funds do pretty much what the stock funds do, but they specialize in bonds, corporate bonds mostly, but they can be pretty much investing in any type of funds, including U.S. Treasury bonds as well as municipal bonds and things like that, or as well as international, as this PowerPoint or this slide mentions. All right, as I mentioned to you, there are also hybrid funds, which again, comparatively small in the space of mutual funds, but they're very effective. They try to combine a lot of these different types of stocks and bonds. A lot of times 401ks offer hybrid funds. Like, let's say when you go into a 401k, it might say like a fund called Retirement 2045 or something like that. Well, that fund will have stocks and bonds and money market stuff all in it. So they would be called a hybrid fund. So then let's look at the money market funds, since I mentioned that just a second ago. Money market funds, again, I'm assuming you know what money markets are. They're very liquid funds, or I'm sorry, very liquid securities that have very low risk. The treasury securities, commercial paper, things like that. Again, I'm assuming you know what those guys are. So money market funds essentially invest in those types of securities. The interesting thing is here, I always tell my students that whenever you put your money into a savings account, the money you will get, or the return you will get from that, is very low compared to what you would get in terms of a money market fund. Now, money market funds are relatively or comparatively very safe compared to bonds and stocks and things like that. And then the question is, why do you make a higher return in money market funds compared to putting your money into a savings account? Well, the answer is they're not federally insured. Now, why do I advise even my own family to go into money market funds instead of just sticking their money into a savings account? Because, especially large banks or large funds or large investment houses that utilize or make these money market funds are so safe that unless something huge, very big, and very catastrophic happens in the market and in the nation goes into this horrendous war or something like that, you don't necessarily need the federal, the FDIC insurers to back up your money. So again, I'm not your financial advisor, so I'm not giving you personal advice to do this, but I tell my family as well as what I do is if I want to park my money somewhere that I might need very quickly, a lot of times I utilize these money market funds just because they're relatively safe and they offer a higher return compared to, let's say, a savings account. All right, so this brings me to another topic called index funds. These index funds are mutual funds as well. The interesting thing about index funds is that they essentially mimic an already established index. Now, I'm assuming you know what an index is at this point, but again, a quick recap, just a very quick recap. Index is a hypothetical portfolio that is made up of, let's say, a particular set of stocks or bonds or whatever the case might be from the market. And whenever you track an index, you essentially track the market from that perspective. So let's say you think of S&P 500, which I give as an example here as well. S&P 500 index is made up of 500 largest companies or 500 of the largest companies in the United States market, essentially. And this index has those companies listed in it. And whenever this index tracks those companies going up or down, we usually say, well, we're through S&P 500 index, we get to track what the large companies of the market does. From an academics perspective, we a lot of times say S&P 500 can be substituted for the entire market. There's a huge debate that that's not the case because it only represents large companies, but that's a whole other discussion. But that's what an index is. So whenever you get into an index fund, let's say index fund for S&P 500, that fund now looks at that hypothetical portfolio and makes it a real portfolio and literally invests in those exact, in this S&P 500 case, invest in those exact 500 companies. Now, the cool thing here is that there's no investment manager necessary for this fund. No decision needs to be made for this mutual fund to invest in. So a lot of times what happens is that they become a lot cheaper to invest in because there's no management fee of this, or there's not a substantial manager fee associated with this fund. But at the same time, it's a great tool because it allows you to, again, as I mentioned at the beginning of the lecture, it allows you to save substantial costs. Because if you wanted to buy each and every one of those, let's say, 500 of those companies listed in the S&P 500 index, it'd be very costly for you to get into that. But if you get into an index fund, let's say S&P 500 index fund, it'd be a lot cheaper for you. Now, I also get this question. Well, Vanguard has an S&P 500 index fund. Fidelity has an S&P 500 index fund. TD Ameritrade has an S&P 500 index. So what's the difference? Nothing, other than them being in different companies. And let's say that you're exclusively investing in Vanguard. The S&P 500 index in Vanguard you get to utilize because you already have your money parked there. But whenever you look at them across each other, there's no difference between those funds other than where they're parked in terms of investment companies. Now, having said that, S&P 500 index fund is just one example of a million different index funds that you can have. As many there are indexes that are popular out there, you will find a mutual fund that mimics that index. I mean, S&P 500 is a broad index fund. You can have specialized indexes. You can have oil index, as an example, and that index, whatever companies are listed in that, let's say, oil index, can have a mutual fund that mimics that. Again, a hypothetical portfolio becomes a real portfolio for you to invest in. All right, this also brings me to the concept of fees. What I usually advise people to do is, if you want to invest in, let's say, Vanguard fund, which are very popular, very comparatively very well managed, and good funds overall. So if you want to get into a Vanguard mutual fund, it's a good idea to have an account in Vanguard, because a lot of times if you have an account in Vanguard, then a lot of funds that might cost money for others to invest in become what is called a no-load fund for you. So what do we mean by load? So let's clarify that. A load fund is a charge, essentially a fee that you get charged to become a owner in that fund or buy a share of that fund. So that would be a load fund. A lot of times funds that are load funds for outside investors are no load funds for home investors per se. And deferred loan is another type of load. I'm sorry, deferred load is another type of load category. And here it says funds charge a fee when the shares are redeemed. So in other words, you don't get charged when you become a shareholder in this fund, but you end up paying a fee if you try to get out of it. And the third one is no load fund. So if a fund charges you no load, even some funds charge no load even if you're not a customer of that investment house. So it happens too. But regardless of what the case is, no load fund essentially charges you no money to be a part of that investment. Oh, wait. So when I say no money, I'm talking about upfront money. This does not include other fees, which I'm explaining in this PowerPoint slide. So other fees, right? These a lot of times exist in no load funds as well. So don't be surprised that you're essentially paying some fee for a no load fund. All right, so I'll read from here and then I'll clarify them for you. Contingent deferred sales charge is one type of fee, a back-end fee that may disappear altogether after a specific period. So these types of fees basically say as long as you're a holder in this fund for a particular time period, we're not going to charge you. But if you get out of us, earlier or whatever, you'll get charged this fee. Another one is redemption fee. Again, just like I mentioned before, it's essentially a fee that you get to pay when you try to get out of that fund. Exchange fee, usually low if it happens. A lot of times if you're in a particular investment house, you don't get charged an exchange fee between funds within that investment house. But if you get charged, it's referred to as exchange fee, and again, it's usually low. Another one is accounts maintenance fee. Although here I say it charges if the account balance is too low, sometimes accounts maintenance fee exists regardless of the balance you hold in that account, but a lot of times it is because you hold low money in that account. But some funds will charge you maintenance fee regardless. And then another fee called 12B-1 fee, and that's basically any fee that is related to this fund's operation in terms of marketing itself, advertising itself, and becoming more popular. You essentially become, since you're an investor in this company, you essentially have to pay some of those fees as well. All right, mutual funds, essentially public companies are regulated by the federal government. I list a few laws here. There are a lot of them. The ones I list here are the most high-profile laws or the biggest impact laws that mutual funds face. But the point I'm trying to make here is that they're federally regulated. But more importantly, I want to mention that they are the only companies in the United States that require, by law, to have independent directors. So in other words, the board of directors have to be made up of people that are not related to the mutual fund. That's the important part here. It's the corporate governance that is forced onto these companies by the federal government by law. So what do we mean by that? What do we mean by independent directors? So let's read the bullet points. Independent directors must constitute a majority of the board. So in other words, companies' board should be either entirely or mostly made up of people that are not associated with the mutual fund. That's already what I mentioned. The second one, independent directors select and nominate other independent directors, which is important. Whenever you have directors that are not associated with this company, you want to make sure that the company doesn't pick the next unassociated director. You see what I mean? The law tries to make sure that these independent directors are genuinely as independent as possible. The third bullet point, which is also very important, is the legal counsel to these independent directors must also be independent. So in other words, who gives advice, legal advice to these directors must not be associated with this company as well. All right, so this brings me to the concept of hedge funds. Now, I'm not going to go in much depth about hedge funds because hedge funds essentially are mutual funds. So a lot of the stuff that we already talked about covers hedge funds. But hedge funds is a unique breed of mutual funds. They're high risk taking funds and their structure is slightly different. And let me mention a few of the differences that hedge funds have from the typical mutual fund. High minimum investment. So in other words, a lot of times you and I have a hard time investing in hedge funds. The average is 1 million, as I mentioned here, but a lot of them are much, much higher than that. In fact, when I was working for this big investment house, when I was looking at the hedge funds that this investment was investing in, some of these funds had a minimum investment amount of 10 million plus. So you can't even get a peek into these funds unless you upfront put $10 million right off the bat. And the amount of money, of course, being invested would be much larger than that. But that should give you an idea of how specialized not only funds can be, but how specialized the investors can be in these types of funds. A lot of times, these funds require a long-term commitment. So it's a unique breed because, as I will mention in just a second, they're risky, but they also want to make sure that if you get in it, you don't get out very quickly. But I'll get into that in just a second. High fees, a lot of times, these funds require a lot of money for you to pay in terms of fees for you to even be a part of these funds. They're highly levered, means they're highly leveraged, they borrow a lot, and they get into a lot of derivatives types trades. And there's not much regulation actually that goes over hedge funds. They're like a closed box, I mean black box that a lot of people don't know enough about. Now, having said that, when I say closed box, they're not required to be as transparent as the other types of mutual funds. That's the thing here. So you can think of them as more private, and they a lot of times regulate themselves. Of course, that opens them up to a lot of possible fraudulent activity as well, but that's the key about hedge funds, that they're not as transparent as other types of funds. Okay, so the key thing here is that hedge funds are more high risk-taking companies, but more particularly, they try to look for arbitrage opportunities in the market. So when a mutual fund tries to be good boys and diversify appropriately, believe in the market and this and that, hedge funds are not that way. Hedge funds try to find these unique arbitrage opportunities, these quick profit things. They try to do advanced analysis, a lot of times very detailed advanced analysis, trying to find these inefficiencies in the market, these mismatches of prices in the market, and try to profit from that. A lot of times they are actually successful in doing that kind of things. So, but of course, when they're successful, because they are a niche type of investment companies, and they try to go after things that are very, I guess, unique in a sense, that a lot of times their bets are wrong as well. Now, here's an example. Long-term capital management is a hedge fund that used to exist. They don't exist anymore. Basically what they did was, this is just an example of what kind of things hedge funds can do. What they did was they basically looked at different very closely related treasury bonds, and they said, well, the prices are substantially different, but we expect them to be so close to each other that they will converge in price in long term. But at the moment, there's a significant difference in price. So what they did was they tried to profit because they thought that, well, they saw that that was an inefficiency in the market. These guys should be very close to each other in price, but when they saw that the prices were not as close to each other as they should be, that created a unique arbitrage opportunity for this hedge fund. Then they profited significantly. By the way, later this fund actually went bankrupt, but that brings me to that next topic. Hedge funds take a lot of risk. They're specialized. That doesn't necessarily mean that there are not hedge funds out there that don't make a lot of money. In fact, a lot of hedge funds make huge amount of money compared to typical mutual funds. But research shows that their persistent beating of the market is not something to rely on. Or in other words, they cannot do this persistently. Or in other words, hedge funds don't, at least research shows, that hedge fund managers don't have this unique foresight that no other manager has, that they can beat the market consistently. That's why from a general investment perspective, we look at hedge funds as high risk taking, and us investing in mutual funds is more, I guess, less risk averse type of investment than we would otherwise. Or in other words, more risk loving or risk seeking people would invest in hedge funds than people would just go with more diversified and general market scheming mutual funds, if that makes any sense. So again, hedge funds are popular. A lot of them go bankrupt. A lot of them make a lot of money. But the ones that make a lot of money, research shows, are not persistent in making the same ridiculously high returns over time. And that brings me to the end of this lecture talking about mutual funds, the big picture of mutual funds as a financial institution. I want you to pay very close attention to this lecture because I will ask you several questions from it. So the reason I pay a lot of attention to this lecture is not because it's important as a financial institution. Why is it an important company that exists? But I'm also interested in for you to understand from an investor perspective that these companies have a lot of power. They actually offer a lot of advantages that you might not be able to get through just regular investment endeavors you can pursue. But more importantly, mutual funds are so infiltrated into the market that mutual funds themselves can steer the market in different ways. That's why they're important to understand, know, and utilize in your investment endeavors whenever you get into it or if you're already in there yourself. Thank you very much for your time. If you have any questions, please let me know. Otherwise, I'll see you guys in the next lecture.